Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. Although Mohnish Pabrai is known for his cloning strategy, did you know that he has two other investing strategies that he uses to his advantage? This week, I'll be covering Pabrai's spin-off investing strategy. When a company spins off a business unit, usually a portion of the overall company into its own separate public company, it is known as a spin-off. The shareholders will own a portion of the new company, and the goal of a spin-off is to create a win-win situation for shareholders and the company by allowing the core business to get rid of a non-core entity while allowing the spun-off company to focus on what it does best. An example of this was when automotive conglomerate Fiat Motor Company spun off one of its businesses, Ferrari. They did this for two main reasons. Number one, they believed it would unlock shareholder value for the current Fiat Motor Company shareholders. And number two, they believed that Ferrari would perform better as its own entity. They compensated shareholders by giving them one new Ferrari share for every 10 Fiat Motor Company shares they owned. So if you owned 1,000 Fiat Motor Company shares, you would have received 100 Ferrari shares. On January 4th, 2016, you could immediately turn around and sell those shares at market price. The share price was around $40 at the time, giving the new owner an immediate $4,000 or a roughly 40% return. You would have done better if you simply kept your Ferrari shares, which are currently trading at $257, or a 3.5 times return for the spin-off price. This is how powerful an ideal spin-off can be, even if it doesn't always work out. It maximizes the value of the underlying entity as well as the shareholders. Joel Greenblatt, a well-known investor, is credited with popularizing spin-offs. Joel Greenblatt's incredible book, You Can Be a Stock Market Genius, was published in the 1990s and is widely regarded as the best book ever written on the subject of spin-offs. Greenblatt explains why the spin-offs outperform the overall market in this book. In fact, he cites a study from 1964 to 1988, which found that spin-offs annihilate the market by a whopping 10% per year on average over that 22-year period. Of course, this was back in 1988, and over 33 years have gone by. So the question remains, do spin-offs still work? The short answer is yes. The reason for this is that the parent company gets rid of a non-core business, allowing that spin-off to concentrate on what it does best. Shareholders, on the other hand, frequently dismiss spin-offs and sell the spin-off shares as soon as they arrive. Institutional investors in particular sell spin-off shares because they're either prohibited from owning stocks with a market capitalization below a certain threshold, or simply do not understand the new spun-out company. In the first few quarters after the spin-off, this leaves money on the table and creates selling pressure. As a result, investing in spin-offs after they have been around for a few quarters is a good idea. Again, similar to Pabrai's Uber Cannibals portfolio strategy, Pabrai only chose 5 stock picks each year. In building the spin-off portfolio, he got help from his acquaintance Jaya Bharat to follow a few rules to narrow the vast amount of stocks out there and select just the spin-offs that are more likely to succeed. If you're interested in finding out exactly what those companies are, I encourage you to read the Forbes article to find out which stock picks Pabrai found over the course of 18 years. But the take-home message is that the spin-off portfolio beat the S&P 500 by 7.9% annualized. In other words, if you had invested $100,000 in the spin-off portfolio in 2000 and rebalanced every year since 2000, it would have turned into $898,000 versus $246,800 for the S&P 500. And here's how that portfolio performs in a historical backtest between 2000 and 2017. There are two key things to take away from this strategy of investing. Number one, investing in the spin-off portfolio during these 18 years required resilience and a lot of conviction. For example, the spinoffs lost more than 25% of their value in 2007 compared to a 5.5% gain by the S&P 500. Number 2, while the spinoffs triumphed at the end of the 18 years, the spinoff portfolio underperformed the S&P 500 in 7 of the last 18 years. This is why, if this investment strategy is followed, it's important to stay the course over the long haul to reap the rewards. To help us out, Pabrai has published the updated annual list of the spinoff portfolio each year on his blog at chaywithpabrai.com. But if you'd like to take a shot at finding these spinoffs yourself, here is the exact strategy he used to get their list of top 5 spinoffs every year, as quoted in the Forbes article. Full portfolio rules for the spinoff portfolio. Selection criteria. Number 1, minimum market cap of $100 million. Number 2, price to sales ratio less than 3. Number 3, the 12-month net income for all the years must be positive. Number 4, the free float of shares outstanding of the previous year must be 70% or greater. Number 5, the spinoff must have been spun off for more than 1 year, but less than 7 years. Number 6, if the spinoff company is currently less than 5 years old, the company is only eligible to enter the portfolio if its parent company has a credit rating above or equal to BB+ by S&P or Fitch or EJR or Bay1 or Moody's. If the company doesn't have a rating from any of the 4 rating agencies, it is also eligible to enter our portfolio. If the spinoff company is 5 years or older, the spinoff itself must meet the same credit rating criteria. Number 7, select the most recent 5 spinoff companies. Rebalance methodology. Number 1, rebalance on December 31st of each year. Number 2, the old companies that are not on the new portfolio are sold. The sell money is accumulated and distributed equally among all new entrants. Number 3, if the same company is present in our portfolio, then we do not change the portfolio's weight in that company. Other rules. Number 1, dividends are reinvested into the same company that paid it. Number 2, if there is an involuntary removal through acquisition, delisting, bankruptcy, then the cash is distributed equally among the remaining companies in the portfolio. Number 3, if there are any spinoffs, the grandkids, the new spinoff company becomes a part of the portfolio. That's it. Investing in a spinoff portfolio is simple. Just buy the constituents in early January, put 20% of the pie in each of the 5 names. The portfolio turns over once per year, as constituents are adjusted to those that continue to meet the rules. Earlier next year, you'll sell the ones that are no longer in the previous year's list and spread the proceeds evenly among the new kids or spinoffs. He also suggests not putting more than 10 to 20% of your net worth in this strategy. Other than the annual turnover, this is a set it and forget it for a year strategy. This strategy only makes sense if you intend to follow it for at least a decade or longer. He recommends the ideal home for this strategy is your IRA. That way, there are no realized gains to worry about. I want to emphasize again that it's important to take notice of the volatility that takes place in the spin-off portfolio versus the S&P 500. If you compare the two side by side, you see that to have invested in the spin-offs over the last 18 years would not have been for the faint of heart. You would have had to endure some very difficult down years while being sure to follow the rules year in and year out. It's extremely important that if you invest in a strategy like this, that you understand what you're getting into and that you keep following the rules for the long term, which means for over 10 years. It can just as easily underperform over short-term periods as it can overperform. It's imperative that you must be able to stick with it. It's clear to see that Pabrai and Greenblatt are big fans of spinoffs, but of course, you're probably wondering what the great Warren Buffett thinks about spinoffs. While digging through his letter, I was able to find out his early years of managing his partnership. Buffett did invest in spinoffs. From his 1963 letter to shareholders, we can see that Buffett categorized his partnership investments into 4 different groups. Number 1, General's private owner basis. Number 2, General's relatively undervalued. Number 3, workouts. And number 4, controls. Loosely, you can consider workouts as the same thing as spinoffs. Here is what Buffett wrote about workouts in his 1963 partnership letter. These are securities with a timetable. They arise from corporate activities, sellouts, mergers, reorganizations, spinoffs, etc. In this category, we are not talking about rumors or inside information pertaining to such developments, but to publicly announced activities of this sort. We wait until we can read it in the paper. The gross profits in many workouts appear quite small. It's a little like looking for parking meters with some time left on them. However, the predictability coupled with a short holding period produces quite decent average annual rates of return after allowance for the occasional substantial loss. This category produces more steady absolute profits from year to year than generals do. In years of market decline, it should usually pile up a big edge for us. During a bull market, it will probably be the drag on performance. On the long-term basis, I expect the workouts to achieve the same sort of margin over the Dow attained by generals. So there you have it. Even Buffett dabbled in these spin-off strategies back in the day. Let me know in the comments below if you think I missed any key insights from Pabrai's spin-off Forbes article in 2017. In fact, the data shown in this video is from that article and from his blog. One important thing to remember is that news comes faster than 1963. Several mergers come undone before the news is even released. Keep your positions tight and disciplined, and employing workouts and spinoffs to make up a small part of your portfolio can help stabilize your portfolio when the rest of the market is zigging and zagging. Don't forget the other special situation of just waiting and reading. Being able to do this in today's day and age is special in itself. Thank you so much for watching, and if you got any value out of this video, smash the like button since that'll help grow this channel. Leave your comments in the section below and let me know your thoughts about this video and what I should cover next.